What is going on, traders? Welcome back to the Traveling Trader. Literally one of the most requested topics that I get is how to trade futures. You're in luck. In this video, I will be showing you from an absolute beginner's perspective how to trade futures. Even if you're not a beginner, I guarantee you will get something out of this. All I ask is that if you get anything out of this video, leave it a big fat thumbs up so that other people can find it as well. And if you want access to the day trading template that I use in Thinkorswim, I will be using Thinkorswim here, although you can use other platforms that support futures. This includes Charles Schwab, Fidelity, etc. Sign up. I will give you this template absolutely free if you use that form in the description below. You will also find a link to our exclusive trading group where we talk about stocks, options, crypto, futures all day, every day. Come be a part of the group if you'd like. Let's get right into it. Everything will be timestamped below, so feel free to forward and rewind as you like. All right, so what are futures? Ever since I was a kid and I saw Trading Places, that Eddie Murphy movie, they were talking about pork belly futures and orange juice futures. I thought that was a joke, but no, it's actually a real thing. And you can use it in order to leverage your trading, take your trading to the next level, and potentially profit even further than you thought. So what are futures? Futures are a type of derivative with an underlying based on a specific commodity or asset, which is the underlying, right? It's a contract to buy or sell at a set date and a set price. These contracts have fluctuating value, meaning they go up and down over time depending on the price of the underlying. They can be bought and sold at almost any time before expiration. So a futures holder can actually sell their position anytime as long as there is a buyer for that position in the market. So some examples of futures include commodities such as gold, wheat, Bitcoin, but also stock indices like the S&P 500 and the NASDAQ. There are futures on oil. There are futures on other metals. There are futures on currencies. There's literally a futures market for almost anything that is tangible. Now, this is very important. Futures can either be physically settled or cash settled. Physically settled means you actually have to deliver the goods to the futures contract buyer at the time of expiration if you held your contract until then, right? So if you're a seller and you held your contract until expiration, and if you're a buyer and you held your contract until expiration, on expiration date, a physically settled futures contract would require the seller to deliver the goods to the buyer in physical form, meaning yes, gold futures, for instance, physically settled gold futures, the seller would actually have to deliver, let's say, 100 troy ounces of gold to the buyer. Same thing with barrels of oil, which is part of the reason why you saw oil go negative in April 2020. However, increasingly over time, cash settled futures have become the norm because they are easier, they're more liquid, they allow buyers and sellers to speculate without really having to move goods. So you'll see here this last point, most traders use futures to speculate. Now, fun fact, futures actually weren't started by speculators. Futures were started by farmers. And futures actually came before options. I will talk about the difference between options and futures because to those of you that trade options that heard me spit all of these facts about futures, you might think to yourself, whoa, how are futures and options different? Well, you will see that in the timestamp below, but I will definitely get to that. Now, futures were actually very important to farmers because if they expected a bad turn of events to happen and their crop prices to drop, well, they could actually sell futures at a certain price at a certain date and time. Let's just say that, and we'll go through an example, but let's just say that they thought that the price of wheat would drop. Well, they could sell futures at $50, and if somebody was willing to buy a bushel of wheat for 50 bucks, then at the time of expiration, if wheat is now 40 bucks, the farmers could still sell their wheat for 50 bucks. And it also works in reverse if they thought that the price would go up. All right, so when do futures expire? Let's talk about expiry dates. Well, it really depends on the type of future that we are discussing. For stock indices, that is futures that are based on the S&P 500 and the NASDAQ, the futures expire on the third Friday of every third month. I know that can get confusing, but here's an illustration on the screen that shows you the expiration dates for the next few years. There are 4 expiration dates every year, so it is like a quarterly expiration for stock indices futures. However, for commodities, each future has a different expiration date depending on the commodity. Now, these can be found if you go to the CME Group's website. That's the Chicago Mercantile Exchange, cmegroup.com. Here, for instance, you will see the settlement date for gold futures and the calendar on the CME Group's website. You can see for each contract, you have the settlement date and you have the last trade, meaning this is the last day that you could trade or close your position. And if you don't close your position, then if this is a physically settled futures contract, you will be required as the seller to deliver a certain amount. And we'll go through what each futures requirement is in terms of cash amount or physical amount. You can find that easily on CME Group's website. But if you don't close your position by that day and it's a physically settled futures contract, you'll be required to deliver goods to the buyer if you are the seller, and vice versa. If you are the buyer, you are required to inherit the quantity of goods per the futures contract specifications. Now, if it's a cash settled position, then your broker will literally just close your position out most likely for the cash value, whether you are in a gain or a loss. All right, hopefully you guys are with me so far, and I promise we will walk through actual trades and how to trade futures. So what is the difference between futures and options? How are they different? Well, options give the buyer the right, but not the obligation to buy or sell an asset at a specific price, meaning the buyer does not have to inherit goods. In this case, options usually are tied to stocks, so they would not have to inherit the stocks if they don't want to. And remember, just like futures, options contracts also have a fluctuating value day by day, meaning they go up and down in price, and you can close your position out whenever you want. Another difference, futures give the buyer the obligation to purchase a specific asset and the seller to deliver the asset at a specific future date unless the contract is closed before expiration. We kind of went over this, but futures give the buyer the obligation. If you are a buyer of physically settled futures and you kept your position open, you are required to actually take delivery of those goods that are specified under that specific options futures contract, right? Other ways in which they are different. Futures are usually much more expensive. Now we will get into the micro futures, which is sort of a variation that was recently created that allow retail traders like you and me to engage in futures trading without having to put up a ton of money. But in general, futures contracts are usually much more expensive than options contracts, and futures cannot be exercised like options can, right? So with an option, you can exercise your position or you can be assigned your position. With futures, you can't. The only sort of assignment that happens is at expiration date if your position is not closed. Most futures trade nearly 24/6. That means 24 hours a day, almost 6 days a week. The actual times on most futures are Sunday to Friday from 6 p.m. to 5 p.m. the following day Eastern Standard Time. So there's usually a break between 5 and 6, and there's usually a break between Saturday and Sunday. All right, hopefully you're with me so far. Why trade futures? What is the benefit of trading futures? Well, one, futures are very liquid. Usually futures on large commodities or popular commodities and stock indices futures are very liquid. They offer more flexibility because of a larger time window. So if, for instance, you're looking to trade options on stock indices like the SPY or the triple Qs, those close when the market closes, and you can't really touch or modify your position until market open the following day. So if after hours something happens and the market starts tanking, well, you have no choice but to wait until the next day in order to try and mitigate your position. By that point, especially during a volatile time in the market, your position can be significantly down, right? So futures offer more flexibility because of that 24/6 time window. There's also potentially more leverage, meaning you get to make more money, you also get to lose more money. But small ticks, and we'll talk about ticks later, the value of each tick depending on the futures contract, you can make large amounts of money with small moves in the indices or commodities. Futures are also not subject to implied volatility the same way as options. For those of you that are semi-experienced with options, I'm sure you've experienced sometimes where you've bought calls and the price of the stock actually went up, but you still lost money. Or you bought puts and the stock price actually went down and you still lost money. Well, that is because of changes in implied volatility and IV crush, or implied volatility crush, meaning that even if you guess right when it comes to options, sometimes if the stock doesn't make a big enough move, but implied volatility drops heavily, the price of your calls and puts can decline even if you guess the direction the right way. Futures, as we mentioned earlier, cannot be assigned before expiration in the same way that options can, and there is no dividend assignment risk. It is also a great tool for hedging. Options are as well, but futures can be an even greater tool for hedging. All right, so now let's run through an example of a traditional futures contract, and then I will practically show you how to trade futures from a retail trader's perspective. So here's an example of a futures contract in case the description that I just lined up for you the past few minutes has not really made sense to you. So this is why futures were created. So imagine that the price of a bushel of corn is $45, and this farmer sells one contract at 45 bucks, and the buyer buys one contract at 45 bucks. So the seller of the contract at 45 bucks expects the price of corn to go down. So they are trying to protect their crops. And the buyer of the contract thinks that the price of corn is going to go up, right? So let's see what happens if the price of a bushel of corn actually drops to $40 and the farmer who sold that contract at 45 bucks is correct. If the price of a bushel of corn drops to $40, then the farmer can still sell one bushel of corn to the buyer at 45 bucks, thereby protecting the value of his crop. And the buyer, if held until expiration, who incorrectly speculated that the price of corn would go up, has to buy one bushel of corn at 45 bucks, even though the market price is currently 40 bucks. So this is an example of how futures were traditionally used and still are used by institutional investors. However, by retail traders, as I said, retail traders tend to use futures in a more speculative manner and for hedging. All right, so now that you know a little bit about futures, let's talk about how to practically trade them. In my view, futures are actually easier to trade than options because there are only two actions you can perform. You can either buy a contract or sell a contract. You can't do any of these extravagant, complicated strategies that you can with options, like iron condors, vertical spreads, butterflies, etc. You can just buy a contract or sell a contract. That's it. It's much closer to buying and selling stocks than it is options. All right, in terms of what brokers allow you to trade futures, you're going to have to check this, but for sure, Robinhood currently at the time of this recording doesn't allow it. Neither does Webull. It has to be an accredited broker like TD Ameritrade, Charles Schwab, Fidelity. Interactive Brokers actually allows you to trade futures, which is good news for those of you that don't live in the US and want access to futures trading as well. Interactive Brokers provides that. Now, if you go to your exchange's website, this is actually a lot easier to use than the CME Group's website. But if you go to your exchange website, in this case, because I use TD Ameritrade, I look on TD Ameritrade's website and you could see all of the futures contracts that they have available, what commodities and assets you can trade futures on. Here are the stock indexes. There's the E-mini S&P 500, which is one of the most liquid, most popular futures contracts you can trade. The ticker symbol for futures is usually prefaced by a /. So we have /ES. Like I said, this is one of the most popular ticker symbols for futures. Now we also have micro S&P 500 futures. I'll talk about those in a second. But you could see here, if you click on the categories in TD Ameritrade, there are the stock index futures, there are the metals like gold, silver, copper, etc. There's energy such as oil, crude oil, natural gas, agriculture such as corn, soybeans, wheat. You get the picture. So I actually think that your exchange's list of futures contracts that are available to trade will probably be a lot better and easier laid out than the CME futures. Now, let's talk about tick size. What is tick size? This is the most important part of futures trading and understanding how big each futures contract is. The ES, for instance, these futures contracts are really large. The multiplier is $50 times the price of the S&P 500, not the SPY. So currently, as of the time of this recording, the S&P 500 is over 4,300 bucks. So the contract size for one ES futures contract is $50 times 43.28, which is why it requires a shit ton of maintenance margin in order for you to trade this. Now, don't fret, especially for you beginner retail traders, there is a much easier way to trade the S&P 500 futures, and that's where the micros come in. Now, keep in mind that in order to trade futures, you will need a margin account on most brokers. The requirements will differ from broker to broker, but most likely you will need a margin account on most broker accounts. All right, so what is a tick size? A tick size is the minimum price increment for that futures contract. Now, remember, depending on how large the contract is, the minimum tick size can represent a large amount of money. So for instance, let's go to ES. Let's just stick to this for example's sake. The S&P 500 E-mini futures, the most liquid futures, or one of the most liquid futures contracts there is, the minimum tick size is 0.25, meaning a quarter of a dollar. So if you look at ES in Thinkorswim, but you'll see up here that the tick size, it does not move in increments of less than 0.25. It moves in quarter of a dollar increments. So it goes from 42.89 to 42.8875 to 42.8850, etc. So, and you can see here represented the price of each order is in 25-cent increments. However, here is one thing you got to keep in mind, that each of those ticks, if you buy one futures ES contract, because it's such a large contract, each tick, each one of those quarter dollar ticks represents $12.50. That means that for each dollar that the S&P 500 moves, the futures contract will be up or down $50 depending on which direction. Again, this could be a stomach turner for most beginners. Now, luckily, we have something called micro futures. Micro futures were created in order to allow retail traders to participate more. The two most liquid micro futures are the S&P 500, which is /MES, and the E-mini NASDAQ 100, which is /MNQ. Sorry, these are the micro E-mini NASDAQ 100. Now, the Dow Jones has one as well, so does the Russell, but these two are not as liquid as the S&P 500 ones and the NASDAQ ones. Now, the cool thing about the micros is they trade at 1/10 of the minis. So the multiplier, instead of being $50, is only $5. And for every 25-cent increment that MES moves, instead of representing $12.50, it represents $1.25, meaning that for every dollar that the S&P 500 moves, the micro E-mini S&P 500 futures, the value of each contract will move by $5 up or down, depending on if you are up or down. So let us execute a trade in Thinkorswim. And again, if you want this day trading platform, and I've actually gone over how to use this day trading platform with regards to trading options. I use this for options and for futures. But if you want this for free, there will be a link to a form in the description. Just sign up there, put your email address, and I'll send this to you for free. All right, so the way that you would do this in Thinkorswim, and it's theoretically the same in any platform, it just might look a little bit different, but you would essentially go to the ticker symbol. In this case, we want to trade the micro E-mini S&P 500, right? The lesser ones, which represent $5 move for every dollar that the S&P 500 goes up or down. And we want to trade those. So in this case, if I look at the MES right now, I can actually see that it is creating a double bottom. So this would be a potential scenario in which I would want to long the S&P 500. Now I can just buy one contract either at market, and because these are very liquid, if you want to pull the trigger immediately, it is most likely okay to utilize a market order and not a limit order because the bid-ask spread is very narrow. So I have my order here set to 1, and I can just click buy market, and I can buy one futures contract on the MES. Now, the cool thing about the way that I have this set up in Active Trader is you can actually see the profit and the loss in real time. On here on the right, you could see the PL open based on the one futures contract that I bought. So if the S&P 500 goes to 4300.75 or the S&P 500 futures contract goes to 4375, I'll make $25. Now, obviously, you would make 10 times this if you bought the actual ES futures contract, but recognize that obviously that requires a lot of collateral. So you could see here in real time what my profit and loss open is, and we are hoping for a bounce in the S&P 500 futures contract because of this double bottom here and the support that it has shown from the previous day. All right, we're now seeing the S&P 500 make a nice bounce, and we are up $47.50 on this position. Remember that if this was the regular ES contract, it would be 10 times this, and you could just go ahead and sell for market. Again, the bid-ask spread is very narrow. If you're happy with your profits, you could just go ahead and sell for market, or you could set a limit order by clicking on the amount the minimum amount that you want to sell this contract for. In this case, I'm just going to sell for market and lock in these $45 profits or $50 profits. Now, what's nice about the micro E-mini S&P 500 futures is the maintenance margin is really low, as you can see here. The initial margin is 690, maintenance margin is 630. You compare that with the E-mini S&P 500 futures, the larger one, and you can see that the initial margin required is 12,540 and the maintenance margin is 11,400. So to each their own. Obviously, if you're watching this, you're probably a beginner and you should not even think of trading the micros, which is basically ES for the S&P or NQ for the NASDAQ. And you could see here, just to give you a sense on the other futures commodities, if you were interested in trading oil or natural gas, you can look up these symbols again on your exchange once you are approved for futures trading. But you could see here that, for instance, the size of one CL contract, which is a crude oil, the West Texas Intermediate crude oil futures, is 1,000 US barrels. So don't get caught with your pants down if you're trying to trade oil futures and get physically settled where you have to take delivery of 1,000 barrels of oil or buy 1,000 barrels of oil for somebody. You can close your position out early. Remember that. You can close your position out early, and most people will be closing their positions out early. Just pay attention to the last date of trade and the settlement date, etc. But one CL futures contract, the size is 8,000 barrels of oil. The initial margin is 9,900. The maintenance margin is 9,000. So even less than the S&P 500 futures contracts, to be honest. Natural gas is even less than that. But you get a sense here for how futures are settled. There are physically settled futures like gold and oil, and there are cash settled futures like the stock indices futures, right? Your best resource in this will be your actual exchange, your actual broker, sorry. So whether it's TD Ameritrade or Charles Schwab or Interactive Brokers, they will have the list of initial margin required for one contract, one futures contract of what you want to trade, and the maintenance margin required, as well as whether they are cash settled or physically settled. And yeah. All right, I'm back in this setup because I wanted to talk about one more thing, which is how to short. Remember, trading futures is not like options in the sense that you don't have calls and puts. If you wanted to go short a position, you wouldn't buy a put because there's no such thing as it relates to futures. Futures are much more closely related to like stock trading, where you can either buy a stock if you expect it to go up, or you can short a stock if you expect it to go down. The NASDAQ is coming up on our resistance line that we drew here. So I'm looking to short this if it gets rejected. It looks like so far it is getting rejected. I do have the 5-minute here on the bottom and the 1-minute up on the top. And if I wanted to short this, I would simply just click sell here. And in this case, I will use a market order because the bid-ask spread is pretty narrow and I want to get my order in as soon as possible. But due to the market environment that we are in, I'm using the 5-minute for confirmation because we could get faked out too much on the 1-minute, especially during volatile environments. So I'm waiting for MNQ to fall below the 9 EMA, which is the blue line here on my chart. I'm waiting for it to fall below it and close below it before I open a short position. So we have confirmation that it is rejected at resistance, but I need an additional piece of confirmation that we will close below the 9 EMA before I open up a short. So that is what I'm waiting for. And once that happens, I will then click sell market, or you could do sell limit. But in order to get your order filled quicker, if the bid-ask spread is pretty narrow, you could just do sell market. So I'm waiting for that to happen. All right, we got a close below, so I'm going to go ahead and sell one of these contracts, these MNQ contracts, by just clicking the sell market button. We got filled 13,766. This is a pretty big flush candle too. Let's see what happens. Currently down on our position about 19 bucks, as you can see here. And again, if you want access to this template, hit me up using the form below and I'll send it to you absolutely free. All right, we're up now in the green, 1150. Let's see what happens with this candle. We're up now $51. This is just on one contract here from this candle drop. So let's see how much we can actually milk this. And I might be looking to take profits here soon if we don't cross below this line, because this previous resistance could act as support here and I don't want this thing to bounce up. All right, we're comfortably below the level that I was fearing, which was former resistance, now support. Still up about $50 on this position. Let's see what happens. All right, now up $136 on this short. So you get the picture. I'm gonna go ahead and close it out here by buying it back. Remember, when you sell it, you wanna buy it back in order to close. And there we go. We locked in our profits for the day on one MNQ contract. Remember, MNQ is the micro version of the E-mini NASDAQ futures. NQ is the larger one that requires a lot more collateral. This was the actual NQ contract. It would require 10 times more leverage, but you also would have made 10 times more money. So in this one trade, you would have made $1,175. So hopefully you got something out of this. You learned what futures are and how to trade them. Please be careful. Paper trade this stuff. Don't jump head first because futures contracts can be expensive. If you want my day trading template that I use for options and futures, absolutely free. That link is in the description below. Just put your email address and I will send that to you personally. If you want access to our exclusive trading group full of thousands of traders where we talk about stocks, options, crypto, futures all day, every day, charting. We have coaches calls. We have a coaches corner teaching beginners how to evaluate companies, how to do technical analysis, how to trade options. That link is also in the description. Would love to have you. Leave a comment down below. Let me know that you got something out of this. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.